QQQ has been the go-to ETF for growth investors for decades. But what if I told you another ETF might outperform it, and with less risk? Ever wonder if there's a smart way to invest in tech ETFs than the classic QQQ? I mean, it's been the top pick for ages, right? It's given us amazing growth thanks to huge tech companies like Apple and Microsoft. But here's the thing, markets don't always go up, and when they dip, holding QQQ can be a bit nerve-wracking. That's where JEPQ comes into the picture. It's a newer ETF from JP Morgan that mixes growth potential with a pretty impressive monthly income. We're talking around 10% a year. Plus, it uses a clever strategy to smooth out those crazy ups and downs we often see with tech investments. So, why are we focusing on JEPQ now? Well, over the next 5+ years, it could actually outperform QQQ, even with all those tech giants in QQQ. Sounds interesting, doesn't it? Let's take a closer look and see if JEPQ might be a smarter move for your investments. Chapter 1. Overview of JEPQ and QQQ. Okay, let's quickly go over JEPQ and QQQ so we're all on the same page. First, we've got QQQ. It's been a popular choice for years, giving investors access to the Nasdaq 100, which is full of tech giants like Apple, Microsoft, and Nvidia. It's a pretty straightforward, passive ETF focused purely on growth. No fancy stuff, it just tracks the index. And you've gotta admit, it's done a great job delivering huge returns when tech is booming. Now, JEPQ. This ETF also focuses on the Nasdaq 100, but it does things differently. Instead of just aiming for growth, JEPQ uses what's called a covered call strategy. What does that mean exactly? Well, it basically sells options on some of the stocks it holds to create extra income, which then gets paid out to investors as dividends. This gives JEPQ a pretty impressive annual yield of around 10%, a huge difference compared to QQQ. But here's the interesting part. JEPQ doesn't completely give up on growth. It still holds many of the same big-name stocks as QQQ, so you get growth potential along with that regular income. Plus, this strategy helps reduce the impact of market fluctuations, making it less volatile than QQQ. Chapter 2. The case for JEPQ. Why it could outperform. So let's talk about why JEPQ might actually outperform QQQ over the next few years. The main reason has to do with how these ETFs are structured and what's happening in the market. QQQ really relies on what some call the Magnificent Seven. You know, those huge tech companies like Apple, Amazon, and Microsoft. They've been driving QQQ's growth for years. But here's the thing, that kind of dominance can be a bit of a double-edged sword. If these companies slow down even a little bit, it could really hurt QQQ since it's so heavily invested in them. JEPQ does things a little differently. While it holds a lot of those big tech names, it makes extra income using a covered call strategy. Basically, it sells options, which brings in consistent cash. That cash not only pays out high dividends, around 10% a year, but also acts as a buffer when the market gets tough. Think of it as a safety net. Now, let's talk about performance. When the market's really taking off, QQQ tends to do better because it's completely focused on growth. But when the market slows down or goes sideways, JEPQ really shines. The income from those call options boosts its returns, often helping it outperform QQQ in those kinds of markets. We've actually seen this happen during volatile times, like the 2022 bear market. Another important thing is risk. QQQ is known for its big ups and downs. Great when things are going well, but not so great when they're not. JEPQ's strategy helps smooth out those swings, making it a more stable investment. So, what does all this mean? If we see slower growth or more market ups and downs over the next 5 years, JEPQ could very well outperform QQQ. It's like getting the best of both worlds: exposure to top tech companies and a steady income stream to balance things out. Chapter 3: Performance Analysis and Real World Data. Okay, now let's back up everything we've been saying with some actual numbers. How has JEPQ performed compared to QQQ? And what can the data tell us about what might happen in the future? Let's start with the basics. Since it launched in May 2022, JEPQ has been steadily gaining traction. While QQQ's growth often makes the headlines, JEPQ's performance during volatile markets is where it really stands out. For example, during the 2022 bear market, JEPQ actually outperformed QQQ in terms of total return. Why? Because those monthly dividends acted like a cushion, softening the impact of falling stock prices. Now, when markets are rising quickly, QQQ tends to outperform JEPQ. That's to be expected, since JEPQ's covered call strategy limits its growth to some extent. But here's the interesting part. In markets that are moving sideways or rising moderately, JEPQ can actually come out ahead. The income it generates from selling options boosts its total return, even if the underlying stocks don't move much. Let's take a specific example. In early 2024, JEPQ managed to outperform QQQ during a period of market uncertainty. QQQ was essentially flat, but JEPQ's consistent income from call options pushed its returns higher. It shows that JEPQ doesn't need huge market gains to deliver solid results. Another thing to think about is volatility. JEPQ reduces the big swings you see with QQQ's full exposure to tech stocks. For instance, during a downturn, QQQ might drop 10%, but JEPQ, thanks to its income buffer and lower equity exposure, might only fall by 6 to 8%. That difference can be pretty significant, especially for investors who prefer a smoother ride. Looking ahead, analysts are predicting slower growth for the S&P 500 and Nasdaq 100 over the next decade, partly because so much is concentrated in a few huge companies. If these predictions are accurate, JEPQ's strategy of combining growth with income could be the winning strategy. So, whether it's the steady income, lower volatility, or resilience in uncertain markets, JEPQ is making a pretty compelling case for itself. But who should actually think about adding it to their portfolio? Let's talk about that next. Chapter 4: Investor Profiles. Who should choose JEPQ over QQQ? If you're close to retirement or already retired, JEPQ could be a really good option. Why? Because its high monthly dividend, around 10% a year, provides a consistent income stream. This can help you cover expenses or reinvest in other things, while still giving you exposure to top tech stocks. Plus, it's less volatile than QQQ, which means fewer worries during market downturns. For investors who are mainly focused on growth, JEPQ might seem less exciting since it limits potential gains. But here's the thing. If you want to reduce risk while still being involved in the tech sector, JEPQ offers a good compromise. It lets you benefit from some growth while softening the impact of market corrections. On the other hand, if you're young, have a long investment timeline, and can handle market fluctuations, QQQ might still be the better choice. Its focus on pure growth means higher potential returns, but it also comes with higher risk. Basically, JEPQ is ideal for people who want a more stable, income-focused way to invest in tech. Chapter 5: Drawbacks and Limitations of JEPQ. Of course, no investment is perfect, and JEPQ has some trade-offs too. Let's talk about those. First off, there's the expense ratio. At 0.35%, JEPQ is a little more expensive than QQQ, which is at 0.20%. While it's not a huge difference, those costs can add up over time. especially if you're investing in for the long haul. Secondly, there's the growth cap. Because JEPQ uses a covered call strategy, it gives up some potential growth in exchange for income. In a really strong bull market, QQQ will probably do better because it doesn't have this cap. So if you're expecting tech stocks to skyrocket, JEPQ might feel a bit limiting. Finally, JEPQ's strategy can be a bit complicated. Its use of equity-linked notes or ELNs and call options might not appeal to investors who like simple, straightforward ETFs. Having said that, if stability and income are what you're looking for, these trade-offs might be worth it. Chapter 6. Conclusion. So, is JEPQ the better choice overall? Well, it really depends on what you're looking for in your investments. If you're focused purely on growth and can handle the ups and downs of the market, QQQ might still be your best bet. But if you prefer a more balanced approach, one that combines growth with a steady income stream, JEPQ really stands out. Its high monthly dividend, lower volatility, and ability to hold up well during uncertain market conditions make it a compelling choice, especially for those who value consistency. The next 5 years could be tough for traditional growth ETFs like QQQ, as concentrated risks and potentially slower tech growth could hold them back. JEPQ's hybrid strategy might be exactly what's needed in that kind of market. Ultimately, it's all about finding the right ETF for your individual goals. Whether you prioritize income, stability, or a smoother investment experience, JEPQ is definitely worth considering. So, is it time to rethink your portfolio? That's up to you.